I'm John Howard, and in today's short video, I'm going to talk about McDonald's and how McDonald's has created one of the largest, if not the largest, real estate empire in the world. Okay, so I personally have not eaten at a McDonald's in a very long time, but it's fascinating to me when you look deeper and see that they've created and become what is basically a globally leading real estate empire. In fact, according to my searches and research, the only entities owning more real estate than McDonald's, and this is in terms of acreage, are the British Crown or King Charles III and the Catholic Church. And these actually, both of these, as you can guess, are not for-profit companies. So in terms of a for-profit company, it seems to me that McDonald's is the largest real estate empire in the world. While it's clear, to pretty much anyone that McDonald's is in the burger business. It wasn't actually clear that they were one of the largest real estate empires in the world, because it's not like their competitors are like that. I mean, I don't necessarily see or read how large the empires of Burger King or Wendy's or some of their competitors are, right? Let's look at Ray Kroc. So Ray Kroc is obviously a McDonald's founder, and as he built McDonald's and grew it fast, he started selling franchises to operators throughout the country. He quickly discovered that he could own the land and even the building, if he chose, of the McDonald's franchisee. So while he collected a percentage of the gross sales of each location, he would also own the land and the building in some cases and collect rent from the franchisee. Again, this is not in every case. This is in a lot of cases. We're talking about a lot of locations here, right? So how does the McDonald's empire look now, 40 years after Ray Kroc's death? Well, as of 2024, McDonald's are now in over 100 countries. They have over 40,000 locations worldwide, and only 15% of their locations are owned and operated by McDonald's Corporation. The other 85% are owned and operated by their franchisees. During the 2008 recession, McDonald's bought up land and property where it operated, elevating their total ownership to 45% of the land and 70% of the buildings at their 40,000 plus locations. According to most sources, the asset value of McDonald's owned real estate is $40 billion. If we look at their business, we see a company doing approximately $25 billion in revenue. Looking deeper, they generate approximately 66% of their revenue from their owned locations and approximately 34% of their revenue from the franchisees. But if you look deeper into their profits, what happens is the margins from the franchisees are 82%, and then the margins from their owned locations are 16%. Obviously, at the own locations, they're taking care of all the expenses, whereas the franchisees, they're just taking a cut of gross sales, so their expenses are obviously way lower. The reality is McDonald's does not seem to be growing too much, but undoubtedly they've built one of the largest real estate empires in the world, if not the largest. So, what do you think? Do you think that this 16% profit margin while owning the real estate is impressive? McDonald's is a real estate investor and a real estate owner. They get 5 benefits from investment property. I believe that it's pretty decent, right? Because in addition to their 16% profits as a real estate investor, they also benefit from 4 other things. They benefit from appreciation. They benefit from paying down the mortgage. They benefit from the ability to borrow against their properties and their land if they need to or choose to. And they also benefit massively from tax savings from depreciation and all the expenses associated with operating the properties. So while I'm not precisely certain how tax law works for corporate investment property, the tax savings that they get are likely just massive, of course, from a $40 billion asset value of real estate. So in general, without the other 4 components, besides cash flow, it seems to me that 16% profit margin is not really too great on its own. I mean, there's plenty of businesses out there that do operate on thin margins, and I'd say 16%, without real estate as part of its investment is probably on the thinner side of margins. But again, there are plenty of companies that do operate like that. With that being their only their only their only sources as a business is their cash flow is 16%, right? Or their profit is 16%. But do you know that there is a modern business model out there right now experiencing higher than 16% profit margins and still enables the other four benefits from investment property? There is. It's called short-term premium rentals. In fact, the most competitive hosts and operators in this space, in this this premium short-term rental space, are experiencing approximately 20% cash-on-cash return on investment. This is, clearly much higher than 16% annual profits, and they get to retain 100% of the real estate empire that they build. And these don't even include, of course, the other four things, which are appreciation, the tax savings from depreciation and property expenses, the mortgage pay down, and then the ability to borrow from the equity of the property if they want to acquire more. If you like any of this content, if you are in a place where you like this rentals content, I have some links in the description. What you can do is you can click on the link, or also an email address. You can contact me if you're somebody that is, if you're interested in maybe speaking with somebody that's a little bit further ahead of you. I have something called an SMTR launch kit, short medium term rentals launch kit. Very inexpensive, and I also have a way to kind of work with people. Again, just very basic, simple coaching in various forms. So you go ahead and see those links in there. Also, you can consider subscribing to the channel or giving the video a like. And then you also, if you know somebody, maybe not yourself, but if you know somebody that might like this content, you can send it to them. Thank you. Here with the 20% cash on cash compared to the 16%. So again, 16% is the annual profits of McDonald's in terms of their owned locations, right? So that is what it is. That's their annual profit. So when it comes to my figure where I say 20% cash on cash, what that means is when you go in to a new acquisition where you buy, if you're going to buy a new premium short-term rental that you're going to then place on Airbnb and other sites, that 20% cash on cash, that's an annual 20% on the cash that you had to put down as the down payment to get it launched annually every year, right? So their actual profit margin is a lot higher than 20%. It's a lot way higher, of course, than 16%. So the point is that the profit margins are way higher than 20%. So thus they're twice. So I don't want to communicate exactly what the profit margins are, but in general, the most competitive hosts and operators, are doing much better than the 16%, and they also get the other four benefits. And then also nowadays with what a lot of the competitive hosts are doing and the owners, they're doing what's called DSCR mortgages, and that stands for debt service coverage ratio. So what this means is that the lending for the mortgage is actually based on the income of the property, not the income of the investor. So if you think about it, the only thing that would be holding back an ambitious investor, from building, let's say, $100 million portfolio, or if they want to go and challenge the real estate empire of McDonald's, the only thing that would hold them back is their FICO score, which is really their mortgage FICO score, and then also the capital for the down payment. So as you can see, as this video and this short video is a talk about, real estate empires and how, again, these DSCR mortgages, I really didn't even know about them until a couple of years ago. And I've been a real estate investor for 2 decades now. But as you can see, this story of McDonald's just demonstrates, the power of just owning real estate and kind of operating your business, on it and getting some cash flow from it over time. I like to call real estate investing the wealth building strategy quinfecta. I don't even know. I'm not sure if quinfecta is a real word, but I just like to use it because with one investment, the investor gets 5 benefits. Of course, rental income and cash flow, mortgage pay down, long-term appreciation, tax savings through depreciation, and then expenses, active income offset, and then the ability to borrow against the property to acquire more investment property if you choose. McDonald's has benefited from the wealth building strategy quinfecta to create one of the largest, if not the largest, real estate empires in the world. And now with DCR mortgages, almost anyone can. So if you like that video, everyone, I have been talking a lot about real estate investing. I do plan to do, more content, in the future, but for now, I'm going to be doing content, related to real estate. You can consider subscribing to the channel or giving the video a like. Also, if you know somebody that is interested in doing real estate investing, you'll see you can forward them this video, or also you'll see some links in the description. You'll also see an email address. I have something that I launched, super simple. It's called the SMTR Launch Kit, which stands for Short Medium Term Rentals. I talk about, in case you haven't noticed, I talk about generating consistent 4- and 5-figure deposits and achieving a $1 million net worth or more through owning furnished rental properties. You'll kind of catch me saying sometimes, do you want to turn a tax liability into a scalable investment with short, medium term rentals? If so, I've created the SMTR Launch Kit, and you'll see it below. Okay, everybody, thank you very much, and let me know if you knew that about McDonald's. Okay, have a great one.